Welcome to the 10 Things You Need to Know When Buying Your Next Home webinar. If your screen is not loading, please refresh your screen. Make sure your view is in participant mode. I'm Patrick Donahue, Marketing Coordinator with Congressional Federal Credit Union, and your moderator for today's presentation. Congressional Federal provides innovative and affordable financial products and services, education, and community outreach to the Congressional FCU family, which includes the House of Representatives, Congressional Support Offices, and functions on Capitol Hill, in addition to affinity and non-affinity select employment groups. Established July 9, 1953, by 8 congressional employees with just $40 in deposits, we have grown to over 47,000 members and still counting. Congressional Federal has developed a reputation as a trusted credit union based on its proven track record of reliability with its members. Our presentation today will run about an hour, including time for questions and answers at the end of the presentation. Feel free to enter your questions into the pod to the right of your main screen. We will be collecting them for a Q&A period. This presentation is being recorded, and an archival link will be emailed to you within the next couple of days. Today's presenters are Kristen Overstreet, SEG Relationship Manager with Congressional Federal Credit Union, and Jeff Klein, Assistant Vice President of Mortgage Lending for Congressional Federal's Real Estate Lending Business. And now I'll turn this presentation over to Kristen and Jeff.
Good afternoon. Jeff is the Assistant Vice President of Mortgage Lending for Congressional Federal's Real Estate Lending Business. He has spent his entire career in home lending business, working for both banks and credit unions. Jeff joined Congressional Federal in 2012 and led the efforts to launch the credit union's in-house mortgage operations. Please help me welcome Jeff.
Thank you, Kristen. Good to be here. Thank you guys for setting this up.
So let's start out by talking a bit about the decisions to buying a home. Most, if not all, of the people in the room are likely renters and pondering decisions to continue renting or to take that leap into buying their first home. And what we are going to discuss today are the key questions you should be asking yourselves in order to help you make this decision. To get a realtor or to not get a realtor, a good real estate agent is worth every penny. Jeff, why do you say that?
So thanks. I guess I'll start off by saying this. A home purchase is the biggest financial transaction that most people are going to experience in their lifetimes. In the D.C. area, the average home sale price can be upwards of $400,000 and quite more in some of the areas around here. I guess the best way to think about it would be to say if you had a $400,000 tax problem, would you want to do it yourself and go without the help of a CPA? No, you'd get a trusted expert to handle that problem for you. Same thing for a legal problem. If you had a $400,000 legal problem, you'd probably want an attorney dealing with that problem on your behalf. So it really is no different for a real estate agent. Notice that I say a good real estate agent is worth every penny because unfortunately, not everyone is a good one. There's a lot of not so good ones out in the market. But a good real estate agent can help you determine buying power, and that goes beyond just simply the amount that you're pre-approved for, which we'll talk about later, but they are experts on the local area that you're shopping in. So they know better than anyone that being approved for $200,000 is not going to buy you the same house, depending on where you're looking. It could be, it could buy you a mansion in some areas, and it could buy you a one-bedroom studio apartment. So it's very important that you have their input as to what you can actually afford and what that number is going to get you, so you can avoid the sticker shock that we often see when people are very, very happy when they get pre-approved and then they come back to us 3 days later and say, yeah, I think I need to change that amount, up it by a little bit. They can help you negotiate and be objective. There's a lot of emotion that tends to come to the surface when you're buying a home, and certainly your first home. It's very easy to get swept away in falling in love with a property. And so having that separation and having that objective expert to be able to tell you that, hey, I know you're focusing on all the good things about this property, but maybe you want to think about this. Maybe you're glossing over the fact that the roof may go in a year or two. So having that objective third party is extremely helpful to keep you focused on what's important. And of course, if you're not a first-time home buyer, they can also help you sell your property if you're a move-up buyer and looking to sell your current place, move out of the area, or just find something new in the same area. So if you find a good one, worth every penny. Now, how do you pick one? Above all else, I would say that find someone you trust. Find someone that you click with. There are a lot of them out there, like I said. Interview a couple. Just find one that you like their vibe. And, of course, obviously look at what they've done, what they can, interview them and see what their bona fides are. But more than anything, it's important to find somebody that you like, because you're going to be spending a lot of time with them looking at properties. And so you don't want someone that you're not going to value their opinion, or that's just going to get on your nerves, no matter how effective they may be. Now, we can help you with that. The Home Advantage program that Congressional offers, you can find information about it on our website, but I say this consistently whenever we do homebuyer seminars, that I think the Home Advantage program is probably one of, if not the best service that we offer to our members. And simply put, it's because we don't offer too many services that can result in literally thousands of dollars back in your pocket. What it is really 4 parts. The one that gets the most publicity is the access to highly rated name brand realtors. But let me take a step back and explain each of the 4 parts, because the first 2 you're going to get the benefit of even if you don't use one of our network realtors. You do get direct access to MLS listings. So MLS is the multiple listing service. That's the central database where all homes for sale get entered. Everyone on this call is probably familiar with Redfin, Trulia, Realtor.com, a lot of those engines, even Zillow, where you can go on and you can get alerts when properties hit the market. This is very, very similar. The difference between the Home Advantage program and the Home Advantage engine and a lot of those sites is ours is as close to real time as you can get, whereas not all the other ones are. There may be a day or 2 delay for the records to be updated. Now, you might think that a day or 2 isn't all that important, but let me tell you, in a hot housing market that we increasingly find ourselves in, forget a day. I mean, hours can make all the difference. So there's nothing more frustrating than getting an alert, seeing a place that pops up and being all excited about it, and then you find out, oh no, that was off the market yesterday. So get access to the real-time listings, set your customized alerts, and just be an empowered shopper. Number 2 is detailed neighborhood information. So the site will give you demographic information that a lot of realtors aren't even allowed by law to talk about. This is something I didn't even realize, but realtors and real estate agents in a lot of cases can't talk about crime statistics, school statistics, things that could get them in trouble from a fair lending standpoint or fair housing standpoint. You can get and slice and dice all this demographic information for free on our site. So, students per classroom, the walk score of the neighborhood, because Arlington is a lot more walkable than maybe Oakton, Virginia, by our headquarters here. Things that you would want to know before you buy into a neighborhood. So again, even if you don't use one of the realtors in the network, use these sites. Just empower yourself to become a smarter shopper. But again, coming back to the network of real estate agents, the Home Advantage program has a network of real estate agents that we trust. We don't have a direct and complete affiliation, but these are realtors that we stand behind their work. We know that we work closely with them. They know the types of services that we rep and warrant to our members, and we feel that they fit in very well with that. If you actually use one of these realtors for your home purchase or your home sale, they will actually give you 20% of their commission back to you at closing. So again, coming back to that $400,000 average sale price, That can be, almost between $2,000 and $3,000 as a credit towards closing costs. Again, not many services that are out there will mean that, or will provide you with that kind of cash incentive. And that can be the difference when it comes to making a competitive offer, which we'll talk about a little bit later. So I can't say enough about the Home Advantage program. You can find information about it on our website, or certainly talk to any staff in a branch or our call center, and we'll tell you more about it.
In my experience, the first question a realtor will ask is whether you're approved or not. Getting a pre-approval now, even if you're not ready, why is this important?
So good point, which is number 2 on our list. And I, again, can't stress it enough. Get pre-approved now. We talk to people all day long that say, I'm just calling in. I just want to know what rates are, or in general, what's the process. But I'm not ready to apply to get pre-approved because my lease doesn't end for a while, or we're really not quite ready. We don't have a down payment saved up. We're just seeing what's out there. And to that, I would say, I guess, number 1, kudos for even making the call. That's the first step. But more importantly, go ahead and get pre-approved. The first obvious reason is that a consultation with one of our mortgage loan consultants, it's free. So the price is right there. Excuse me. There's no cost to it. It's a conversation. What we will actually do is take virtually a complete loan application, which is going to seem like a lot of information, but there's a reason. We're going to, at the end of that 15, 20-minute conversation and application, everything but a purchase address, since you don't have a property yet, we're going to go through that, and we're going to get you a pre-approval letter that is valid for 120 days. And beyond that 120 days, we can refresh it literally in a matter of minutes. But what I have seen time and time again is that while you think you are a number of months away, the perfect home just has a tendency to pop up out of nowhere. It happened to me in my life. I didn't think we were imminently looking for something, and we drove by and saw an open house, and next thing I knew, 24 hours later, we were under contract. So that happens to people all the time. Better to have that letter to know how much you can afford way ahead of time so that you're not scrambling. Scrambling is a word you're going to hear consistently throughout this home purchase process, and we want to avoid that whenever possible. It's also better to clear up any issues that may be bubbling under the surface that you don't know about well before you have a specific property, because then the clock is ticking. And what I mean by that is it could be something that showed up on your credit report that was valid or invalid. It's there and it has to be dealt with. You don't want to be trying to chase down an old cable company or an old medical bill or collection that you thought you settled 5 years ago, or an old credit card company that's no longer in business. You don't want to be dealing with those issues on the clock. You'll have enough stress going on of embarking on this single biggest transaction in your lifetime. Those are the last things you're going to want to be dealing with. So have the conversation, get pre-approved, even if you don't think you're quite ready, and at least know what you're dealing with. Best case scenario, there are no issues and you're good to go, and it is a couple months, but you just never know is all I can say there.
Qualifying for a mortgage is a lot easier than I thought. So should I be afraid of the process?
So you shouldn't be afraid of the process, and I think the reason we have number 3 on this list is that it's a lot easier to qualify is probably more than anything that there are a lot of headlines and a lot of articles that you will see on the internet, newspapers, if anyone's still looking at those. But it does make for a great headline that, oh, it's impossible to qualify for a mortgage. And it's just simply not true. It's not true at Congressional, and by and large, for the mortgage industry in general, it's not true. Now, is it as easy as it was pre-financial crisis 10 years ago? Of course not. And that's for good reason. There was a lot that went on back then that just wasn't smart business decisions, and it didn't do anyone any good. Certainly not borrowers. But now we're in a good environment where I think the credit decisions that are made, for the most part, we're moving back towards common sense lending. That's certainly what we try to abide by here at Congressional. But it is way easier than you think. I saw a survey that Fannie Mae had done not too long ago where they asked first-time home buyers, what do you think the minimum credit score is? What do you think the minimum debt ratio is? What do you think the minimum down payment is to qualify for a mortgage? And the answers were honestly nowhere close to what the reality was. people by and large thought that you had to have a much lower debt ratio, a much higher credit score, and a much higher down payment. And they're, in many cases, shocked to find out that, oh, that's not the case at all. The problem is that a lot of people don't even make that call. They just simply disqualify themselves without actually talking to a lender or calling their credit union. So, you know, we certainly do offer the gamut of programs. Some of you may have heard these terms before: conventional conforming, Fannie Mae's Home Ready program, jumbo loans, always helpful in this high-cost area that we're in the D.C. area, FHA, VA, low or no down payment solutions, 100% financing. That's something that we will talk about in a minute. But the bottom line is that we like to say that we have very few non-starters. We do look at the whole relationship. We do look at the whole financial picture. You know, the mortgage industry over the past decade has moved, like it or not, into an area where they've created this box, and people feel like they're being sorted. You're either in the box or you're out of the box. And, you know, we try not to play by those rules. Where it makes sense, we look at the whole picture, and, you know, we kind of make our living around the edges, where there are good credit decisions to be made and good, reliable borrowers to be lent to, but it may not quite look like the box that's been drawn by other lenders. So again, it's kind of another way of saying, have the conversation, call a loan officer, just tell them what the story is. And we can't always say yes, but what we do try to do is say not now instead of no. So if it is a not now, we'll give you a path forward. And it may be 3 months, it may be a year, but we'll give you a path forward. And that's what we do every single day.
Now that we've got some additional information on qualifying for the mortgage, can you tell me how much do I really need for a down payment? So
I guess on the last slide I kind of gave the answer, and I buried the lead there. It's the answer would be zero. You know, the first thing I will say is that the average CFCU first-time home buyer, they only put 14% down. So for those who think that they need 20% down payment, that may be the number that was always out there years and years and years ago, but that's not true. You do not need a 20% down payment. So while the average home buyer is putting only 14% down, almost 20% of our home buyers are putting less than 3% down. And many are taking advantage of our 0% down, 100% financing program. Now, you might say, if anybody has any, or has talked to other lenders or has a background in risk, you might say, oh my God, why are you offering zero down payment loans? And the reason is because we put a lot of time and effort into understanding the needs of our membership. And the one thing that we have heard consistently when we talk to members is that we've got a lot of people, particularly in the DC region, that have great credit. They are great credit risks. They just haven't been able to save a lot for down payment. It could be because of student loans. It could be just because the high cost of rent. You know, they're taking, because they want to have a place, and they may be sharing it with 3 or 4 other staffers on Capitol Hill, but they want it near their offices on Capitol Hill, and every penny that they get has to go to rent. So the prospect of saving 20% for a home, maybe out in the suburbs, that could be a 5 to 10 year period. So rather than simply tell those people, yeah, come back to us in a number of years, we developed this program where, yes, it's for good credit risks, and it's for, there's a more restrictive credit score, but if you're going to pay that loan on time every month, let's get you into that home sooner via 100% financing solution. And we've got a number of those that we can offer, different products that meet different needs, but it does get you, it does allow you to enter that home ownership a lot sooner than I think people would think. And the one important thing to remember is that waiting until next year or 2 years or 5 years has a cost. So I understand at the end of the day, you're the one who has to sleep at night, and nobody wants to, we certainly don't want to give you a loan that you can't afford, but just keep in mind that if you can afford it, by waiting till it feels a little bit better next year or the year after that, that money that you saved may actually just go to offset interest rates because, you know, I certainly don't know when, I don't know how much, but there is a general sense that interest rates are much more likely to go up than they are to go down over the next couple of years. So, you know, one of the things we do for our members is we can run a buy versus wait analysis and give you a presentation which will show you, okay, you know, this is how much you could borrow now at X% interest rate. Well, let's say if you waited for a year or two and we added on 0.5% of interest rate, you know, this is your affordability and this is what your payment's going to be. And in many cases, it turns out to be the exact same. So again, as long as affordability is there and you have an ability to repay, you know, why not have that conversation to see if it can come a reality a lot sooner.
ARMs aren't a four-letter word. I've heard of ARMs. Adjustable rate mortgages are the best. Is that true or is that not true?
Well, I am a big proponent of ARMs, and I guess the first thing I would say is that I guess that's not technically true. I'm looking at ARMs, and there are, in fact, 4 letters in that word. So I'm speaking on more of a figurative basis. But, you know, you brought up the point, are they the best? You can never say that any product is the best because the fact is that not every product is the best for all borrowers. Everybody is different. The product that I would recommend to a first-time home buyer who's only planning to be in DC for 2 or 3 years might not be the same product that I would recommend to somebody who's found their forever home and is settling down with their family and they don't intend to move anytime soon. So the first thing that I would just hammer home to everybody is that every situation is different, and that's one of the things that the first time you talk to one of our mortgage loan consultants, they shouldn't say a word. You know, they should just kind of let you tell them everything about you and what your goals are, what your plans are, how long are you going to stay in the area that you're in, what your risk tolerance is. It's a listening exercise. Now, once they understand that, then they can start to match up what we have to offer to your needs. But the second thing I would say is that almost everybody who comes to us starts the conversation by saying that they want a 30-year fixed. The 30-year fixed rate has long been thought about as kind of the bedrock product in the mortgage industry. It's the gold standard, but it's not a one-size-fits-all. You know, I understand why it is. It's stable. It's secure. You know that your rate is going to be fixed for the next 30 years. But you know, the flip side to that is, just like I said in the last item, that waiting has a cost, that security has a cost. And it's a cost that's paid by the member, by the buyer. The rate on the 30-year fixed is almost always going to be the highest of any product. And that's because we are at our, you know, we're taking the risk to grant you the same interest rate for the next 30 years. So we have to be, and I say we, but any lender has to be compensated for taking that risk. And when you think about the fact, think about your own lives, you know, can you say without a doubt and for certainty that you're going to be in that same house for 30 years? I mean, a lot of us in the DC, Maryland, Virginia area, you know, we're thinking 2 years ahead of time, forget 30 years. So we know over history the average lifespan of a mortgage is about 7 years, and that went way down over the last 10 years when everybody was refinancing, and it may go up a little bit, but it certainly isn't 30. So when you look at the costs next to, you know, product versus product, and you think about the extra money that you're paying every single month for that security, it can be thousands in interest costs. If you look at these 2 charts that you can see on your screen, you see the difference between going with a 30-year fixed and a 7/1 ARM. Now, a 7/1 ARM is what we call a hybrid ARM. That's fixed for a 7-year period, and then it adjusts every single year. That's pretty much how most of our ARMs work. They're fixed, I guess I should say all of our ARMs work. They're fixed for some period of time, and then they adjust subsequently through the end of the life of the loan, which is 30 years. But what you can see here is that we're talking about $208 a month that you're saving on that 7/1 ARM, and again, fixed for 7 years. So it really is a little bit of the best of both worlds. What does that mean? After 7 years, you saved $23,000, almost $24,000. And people don't see that, because it's not, you know, cash that they're getting, but it's savings of money that they're able to keep in their own bank account, credit union account, that they can put to another use or invest. That that can be a pretty sizable sum. And I have a feeling that if everybody had to pay, it's one thing to say stable and secure, that's what I want, and that's true for a lot of people. Some people are just risk averse. But is that stability and security worth $24,000? If people had to actually pay that up front and cut a check for $24,000, I think their answer might be a lot different. And it's also important to note that you don't, you'd say, okay, well, what happens? What if, right? You start to think, I think I'm going to be out of the house in 5 years. I think I'm going to move up. But what if 5 becomes 7, 7 becomes 8, 8 becomes 10? Well, it's not that you have to fork over all of your savings back on year 8. I mean, it starts, the rate adjusts to the market rate. Could go up, could go down. We don't know what rates are going to be. But even in a worst case scenario, if it went up, you just start eating against those savings, but it could be year 10, 11, 12, 13 before you really break even. So again, I don't show this to back a certain product against another because, again, everybody's got to determine for themselves what they're comfortable with. We always say you're the one who has to sleep at night. And we don't get anything out of it one way or the other, whichever product you pick. We want the one that works for you. But what is important is that you actually come into it with an open mind, take a look at the numbers. We will help you get the information that you need to make that educated decision. And if that happens, then we're happy no matter what product you choose to take.
So credit scores and income go hand in hand, and you can't have one without the other. How does my credit score affect my loan?
So this is one, when we do these seminars in person, we have a little bit where we do fact or fiction or myth or reality, and I didn't include, in the interest of time, the entire segment, but we did feel it was important that we took this one because we hear about it a lot. It is a myth because we do hear people say, well, it's okay because my spouse has good credit or a co-borrower that I have has good credit. I don't really need to worry about my own score. And while that can be true up to a point, there's another half of that you do need to worry about, because the first thing I point out that not a lot of people know is that when it comes to mortgages, lenders use the lower of both borrower scores. Now, that's not always true on an auto loan. That's not always true on a consumer loan, a credit card, other facets of personal and consumer lending, but it is true for mortgages. So think about the fact that if one of the two of you has let their credit go a little bit and hasn't been quite as diligent in paying the bills on time, thinking that the other one has the good one, you want to be careful. And the reason for that, well, the reason is obviously because we're using the lower of the two. Now you'd say, okay, can I drop one? Can I only use one person on the loan? The answer is yes, again, but ownership stake and loan obligation, those sound like fancy terms, but basically, if you're obligated on the loan, if you apply for the loan itself, that's different than whether you take title and actually own the property. Because we hear people sometimes, we say, well, what if we just use borrower 1 and drop borrower 2? And the husband or the wife says, well, no, I don't want that. We want joint ownership over the property. Well, that can still happen regardless of which one of you two is on the loan or both of you is on the loan. And the opposite is true. You can have, in many cases, 2 people on the loan, but have one person owning the property in its entirety. But the key thing to remember is that graphic right there, that credit scores and income, they go hand in hand. If you drop a person from the application so that you want to avoid using their credit score to qualify for the loan, you've got to drop their income as well. So if you have that example that I used before where the one borrower has let their credit go, but they're the one making the majority of the income, well, you might have a problem because you dropped the one to get rid of the score, but now you just dropped their income as well, and you might have a problem qualifying using just the other borrower's income. So credit scores and income, hand in hand. Just remember that graphic forever, and you'll be okay.
What are the 3 things an offer should be driven by?
So this is one, and obviously when you meet and you pick a realtor and you go through how to make an offer and how to make your offer stand out, they'll explain in detail all the mechanics, but I always like to think about it in terms of these 3 categories, because there's only so many levers you can pull, and honestly, we're in a market now where the supply, again, going back to the headlines, you've probably read about this, there's just not a lot of supply out there relative to all the people who are flooding the market trying to jump in there. So home sales, haven't quite been where everybody has wanted them, but it hasn't been for a lack of trying. There's just not a lot that's out there that meets everyone's criteria. So it's not uncommon to have a home go on the market and within a day or two have 6, 7, 8 offers, and the seller has to pick one. And you say, okay, well, how do I make my offer stand out in this competitive market? And it does come down to these 3 categories. So the first is really how much, and this is kind of what everyone focuses on, but it isn't everything. So what is the price that you're going to offer? And you'd think that intuitively the seller is going to pick the highest price, but that, again, is not always the case. Price is the most important part for a lot of people in terms of how much, but there's kind of the top line price and then there's the bottom line price, because seller concessions play a part in that. You can actually propose a price or offer a price, but then ask the seller to kick some back to you in terms of a concession to help with closing cost. Well, you offered a good top line price, but net to the seller, it might not quite be as much. So all those things that factor into how much money the seller will end up walking from the table with, that's really how much. This is how soon. So in the offer that you actually make, you're going to have a settlement date, a closing date. So you will go in there saying to the seller, this is the day, it cannot exceed this day. This is when we're going to close. It might be a little bit earlier, but it won't exceed this date in time. Typically, that date will run 30 to maybe 45 days, but it's really what you can offer, and that's going to drive how aggressive you can be. Is, do you have to worry about selling your own home? Are there other factors? Now, most sellers, again, everyone's different, but most sellers probably want to close sooner rather than later. Now, it may be that they have a situation where they can't get out of their home quite as early, but again, by and large, most people see a 15-day offer or a 60-day offer. They want certainty, right? They want to know that it's going to close, so they'll probably lean towards the 15-day closing. So that's how soon. And then finally, how likely. This may be the most important. Again, everybody focuses on price, but what does that mean? How likely is the sale to actually close? Because an offer is great, a ratified contract is great, but as you will see the more we talk in a few minutes, a ratified contract does not mean that the sale is guaranteed to happen. So what are the things that drive how likely? Well, what's the financing for the offer? Is it an all-cash offer? An all-cash offer has, you don't have to worry about a loan at all. So that's, on the scale of how likely, pretty high, right? If it's not all cash, what type of loan is the borrower looking for? Are they putting nothing down on one of our 100% financing, which gives us very little wiggle room? Or is it an FHA government program, which has a more lengthy processing time? Or a host of different other products. But there is a very big difference between the all-cash offer and the financing offer, because the seller just, in some cases, may not want to even deal with the loan process at all or the lender at all. And then finally, contingencies, which is a good segue to the next one, because I'm sure you're wondering, what is a contingency? But contingencies are huge in terms of how likely a deal is to actually close. A contingency is, think about it as a legal out of the contract. So when you actually make your offer, the seller accepts it, all parties execute it, it's called ratification. So I said before, a ratified contract is great. Now you've got agreement between the buyer and the seller. And the buyer, as part of that, as part of your offer, and again, this is another one I didn't touch on for how much, but you're going to put down what's called an earnest money deposit. That's some of money which will go into escrow and say, hey, I'm going to complete this transaction, and if I don't, I'm going to forfeit this earnest money deposit. Well, the higher the earnest money deposit, which is the more skin in the game you have, the seller will look upon that pretty favorably and say, okay, well, that's going to increase the likelihood, right? If it's a huge amount, you're not just going to up and walk for no reason. And that's all true except for any agreed upon contingencies. Again, they're legal outs. You get a free out to get out of the contract with your earnest money deposit if one of these pre-agreed upon contingencies actually does or does not occur. So the common ones that we see a lot, appraisal contingency. So the home's got to appraise at a certain value. We'll talk about that more in a minute. Financing contingency. Buyer has to actually get approved for that loan. Obviously, if it's an all-cash deal, you don't have to worry about a financing contingency, so it's much more likely to close. a home sale contingency. So the buyer's got to be able to sell their home first because they need the profit that they're going to get from their own sale to be able to put as the down payment for their new sale. Well, as you might imagine, that could create a pretty long chain of events that actually has to all happen in order for this sale to happen. So a home sale contingency can be a big-time question mark as far as how likely. Home inspection contingency. So in most cases, the buyers, you're going to agree upon a deal, and then the home inspector gets in there and finds out all the potential problems that lurk beneath the surface. And the buyer can walk a lot of times if they're unhappy with the results. Again, decreases the likelihood. So you look at all these contingencies and say, well, they're good, right? Well, they're good for the buyer. They certainly protect the buyer, but the other side of that is that it does severely weaken your offer because, again, it comes back to reducing the likelihood that the transaction will close. So just remember, again, your realtor, your agent, they do this all day long. They will sit down and consult with you and say, okay, this is the offer that I'm thinking of. This is how we're going to go in with our best foot forward, because maybe they've talked to the seller's agent and they know the motivations, but it does come down to how much, how soon, how likely.
If the home is appraised differently than the selling price, what does that do? Appraised values can trump sell prices.
They certainly can, and this is one that's always a shock to people when they get into the process, because if everyone remembers back to school, you're taught, and it's kind of intuitive to think that, well, what is something worth? Well, it's worth what the market will pay. Value is what the market will pay. Except when it comes to home buying and lending on a home, that's not always the case. And you may remember in the last item I talked about an appraisal contingency. Well, if you go in with an offer for $200,000, the seller agrees, the buyer and seller have agreed upon a $200,000 sales price for a property. Except when you go to get a loan on that property, does the lender really care that two people out of a sea of whoever agreed and thought that $200,000 was the value? Well, you may have the buyer may be extraordinarily wealthy and money's no object, and they just fell in love with that home and they pay whatever it takes. So $200,000 may be the value, but it may also be severely inflated. A lender is really only concerned with what it could resell the property for in the event that the buyer stopped paying and they needed to foreclose. And again, just because one buyer is willing to pay $200,000 for that house, if the rest of the logical market is only worth lender can only sell it for $160,000, then that's the value that they're going to lose. So lenders use the lower of the appraised value and the sales price as the basis for the amount that they're willing to lend. And we do see that from time to time where the member comes to us, they apply, they agree, they're really, really happy about this home, and the appraisal comes in less. Usually what will happen is if your contract has an appraisal contingency, it'll give you an opportunity to renegotiate with the seller. Now the seller can of course say, nope, I get that that's what your appraisal said, but I'm sticking to my guns and it's $200,000, and then it's really up to the buyer to determine if they need to bring more down to the table or they're just going to want to proceed with the higher loan amount. It doesn't disqualify it, but it does tend to throw a wrench into the process. So just remember that coming to agreement on a sales price is really only half the equation, and you're never really in the clear as far as the value goes until you get that appraisal back.
Buying a condo carries additional considerations. How do condos work with a mortgage?
So we live in the DC metro area, and there are an abundance of condominiums. Condominiums, contrary to popular belief, they're an ownership style, not an architecture style. So people assume, we'll see a single-family house sometimes and say, oh, no, it can't be a condo because it has, it's not touching anything else, or it looks more like a townhouse. Condominium simply means that it's, your ownership involves what they call the walled in. So you have the internal space, and it's part of a shared association of all the owners in the association, but you don't own the common areas. And so one thing that we always say is, I say up here on the screen, it's not all about you. While we will, as the lender, underwrite you, and that's very important, we will also underwrite the property and the project, it's the condo project itself. you heard the expression that when you get married, you don't just marry the other person, you marry their entire family. Well, this is very, very similar to that. Your neighbors and things that are well beyond your control, and honestly, that's some of the toughest calls we have to make is when we tell a member that's been a long-time member, great credit risk, that unfortunately we can't approve the loan because of something that is, they have nothing to do with, because the project itself is 70% vacant, that there's an extremely high investor concentration, meaning that all the units are rented out and they're constantly turning over, that maybe the project itself, 60% of the owners are delinquent in their dues. Well, what happens if there's damage to the common areas and the project can't afford to fix the damage to the common areas? Again, going back to if the lender has to foreclose, that's going to have a negative impact on the value. So just keep that in mind. Condos, before you may fall in love with the property, just ask your agent the right questions. What are some of ask the seller's agent, for some of is this condo what they call warrantable? Is it passing muster with other lenders, so that that there's another hurdle to be gained before you're able to truly relax as far as the property goes. The other thing to think about condos is that they have a monthly homeowners association fee. So those dues that I talked about earlier that people were delinquent on, that's a monthly fee that every owner has to pay into the association to keep the project going, to pay for maintenance, to pay for the lifeguards at the pool or the gym, or keep everything in the common areas in great shape and viable. Well, depending on the project itself and all the amenities that are offered, that can be a very steep homeowners association fee, a very big monthly fee, and that can reduce your affordability. So just keep that in mind when you're talking to your loan officer. If you're telling and trying to figure out how much you can afford, if you're looking at condos, tell them you're looking at condos so that they can make sure they put in a variable for what that condo association fee is, so that you don't get excited that you can afford a property, because you'd say, hey, I got pre-approved for $300,000. Well, then you find a $300,000 condo and you're shocked when your debt ratio goes up because you didn't think to tell the loan officer that there was a $400 fee every single month. Some of these fees can be in excess of $1,000 in some cases. I always say to myself, I hope there's massages being given every Friday at 5 for that fee, but that's, some of these condos are really, really nice. So, hopefully you get what you pay for, but it is something to keep in mind. Q&A.
Yes, and at this time we'll open the floor to questions.
Yes, we're going to invite anyone with a question. If you haven't already done so, please type it into the pod at the top right of the screen. We'll hopefully get to all of your questions, but if we run out of time, we will definitely respond via email. And that looks like we have a question.
Good.
What are some of the common deal killers?
No deal killers, things we hope to never have to deal with, but unfortunately that's what takes up the majority of our day. And what you hope is that they're merely hurdles and not deal killers. And that's probably true for the majority, is that we're able to get to closing. It's just always expect the unexpected. We certainly do on our end because we've seen it all. But more than anything, I think it's probably number one, the one I just talked about, which is the appraised value. People are just shocked to figure out how it's possible that a place that they agreed with on the seller for a certain price doesn't appraise for that price. And again, it comes down to not only what people think the house is worth, but what could they sell for. So when we talk to people more on the refinance side, we say, hey, what's your home worth? And they tell us, what their opinion is based on is how much money they put into it, the level of the quality of materials that they put into a renovation, and all those things are important, but it's not as important as what other similar, or what we call comparable units, have sold for in the direct neighborhood. So that's probably number one. Number two is the home inspection issues. I talked about the home inspection contingencies. Place looks great when you do the tour, but when you get the home inspector in there, you find problems with the air conditioning unit, the HVAC, the roof, we'll do a termite inspection in most cases, things that you just can't see, and it causes the buyers to say, hey, do I really want to is this the house that I want to purchase and spend the next 5 years spending through my teeth, fixing and refurbishing, et cetera. So, people kind of walk from the contract that way. And again, if you had a home inspection contingency, you're not forfeiting your earnest money deposit, but it does delay the process. And it can be pretty emotionally upsetting when you've already mentally been picking the colors of your carpets and paints, and now you find out that you're not going to get the house after all. And then finally, when you have that initial conversation with the mortgage loan consultant, it's very important that you tell them not only how much you make, but how you make the money and how much of it is, because what we found more than anything is that there's a very big difference between how much you make in terms of what shows up in your bank account and how much you make in terms of what an underwriter can actually use. And what I mean by that is underwriters are concerned with stability of income, likelihood to continue of income, and if you make X dollars but 70% of it was a one-time bonus, no one's denying that you actually got that money, but we can't use it to qualify you for the loan. And sometimes what sounds great and you're pre-approved up front, when we actually start getting pay stubs, tax returns, documentation, that's when we start to run into issues because, again, nobody's right, nobody's wrong. It's just a very different definition of what we can use. So that kind of ties back to what I said about getting pre-approved earlier, because better to know all this now and have a plan to deal with it than once you've entered into a contract and you've got 28 days before you're supposed to settle, and we're trying to figure out a plan B or a plan C, as the case may be.
Thank you for that question. Moving on to the second question, Jeff. What about inheriting part of a house? What type of mortgages should I get?
So this is one that pops up a lot. Very good question, because it fortunately happens a lot. As far as what type of mortgage to get, you can get pretty much any mortgage that meets your individual needs. So when the property's inherited and once it's finished through probate, and again, have the conversation early, but just keep in mind that the estate, all that estate details have to be settled before we can actually officially move forward, but you certainly can have the conversation. But once it's in your name, then you are free to pick any of our products. I think what mainly comes down to, more than anything, and that's why I keep coming back to it, is how long you think you'll be in that house. That and your risk tolerance drive product choice more than anything. Because again, if you know or strongly suspect that you're not going to be in that house for longer than 5, 7, 10 years, why spend all the money on a 30-year fixed rate mortgage? But beyond that, everybody's situation is different, and that's the first thing that we talk about with our mortgage loan consultant, is what is right for you and what makes you sleep comfortably at night.
Thank you for that question. Moving on right along to the next one. What do you do when an inspection issue arises?
So when an inspection issue arises, and I would say that when there's an inspection, there's almost always something that comes up. I mean, and inspectors, I think, better or worse, and it's usually for better for the buyer because it protects you, but I don't think anybody feels like they've earned their work if they come back and say, nope, everything looks good. They always come back with something. Some are minor recommendations, some they're just pointing it out, and others have the potential to be more serious. But more often than not, it doesn't result in the deal being completely dead, but it does result in a secondary negotiation, I would say. So what would happen is you, in consultation with your agent, you'd say, okay, we're going to go back and ask for this. We want this to be fixed, this to be fixed, and this to be fixed. And then the seller could come back and say, okay, we'll fix this, and this one we're not going to bother to fix, so we'll just give you an extra $500 or $1,000, and you come to an agreement on something. Now that's for the one that's going to depend on how much you truly love the house, and it's going to depend on the seriousness of the issue. But it's very, very common. What we usually see is the initial purchase contract, and then subsequent to that we see an addendum that says, okay, seller has agreed to fix this and pay $1,000 in exchange for, waiving of the home inspection contingency, and you move forward that way. Your realtor would give a better set of advice on this, but my experience has always been that if you're going to rely on the seller to fix it, just keep in mind that they're not exactly going to spend up on quality there. They're going to fix it probably in the most cheap manner possible. So if you can get the money and do it yourself, that's my personal opinion. Again, talk to your agent about that, because that's probably much more their specialty than my own. Do we have any other questions, or is that?
That seems to be it.
Well, we got one more late one.
One more.
Can you refinance an adjustable rate to a fixed rate if plans change and you are going to be staying longer in the property? Great question, and the answer is absolutely. So the first thing I would say is that none of our mortgage products have what they call a prepayment penalty. So literally, if you wanted to, 2 months after closing, you could actually refinance again. There's no prepayment penalty that you'd have to pay for getting out of that mortgage early. That's not true for all lenders, but it's certainly true for credit unions and congressional. And yeah, absolutely. I mean, I think that's what a lot of people end up doing, because people will take a 7-1. I mean, using myself as an example, I've only had ARMs since I've been a homeowner, and I've refinanced a number of times. And every time I do it, I kind of take stock and say, okay, well, how much longer am I going to be in the home? And in some cases, I've stayed in the house and just refinanced to another ARM. But I look back and I say, okay, well, if I'm ahead of the game by, say 15,000, because if I had taken that 30-year, this is where I would be and this is where I am now. So I'm working ahead. I mean, I can't tell you how many times people took a 30-year fixed in the last, 10 years and then refinanced it 2 years later when rates dropped, and then refinanced it again when rates dropped. So every time you think the rates are not going to go any lower, what we've seen is that they continue to go low. Now, I wouldn't bet on that happening again in the near future, but it happens. So more likely than not, you always have that freedom to refinance, or in many cases, life happens and you end up moving. You get the job offer that you never saw coming and you leave the area, or you find that perfect house, or you just get frustrated with your commute and you say, I can't do this anymore, I'm going to move. Nothing is final. It's very rare that people find their forever home and actually stay there, even if it seems like it at the time. So great question. You are always free to refinance.
We'll take this last question, and the question is, how do you deal with situations of unpaid medical leave? For example, say a home buyer has plenty of saved up for a down payment and recovers his regular salary after the leave, but in the doc it shows up as a year later with lower than unusual income.
So that's a very good question, because this, and not even so much the specifics of this one, but this type of question encompasses a large part of what we do, because again, it comes back to life is rarely clear-cut. It's rarely black and white, and we all have the story that goes behind some of this stuff. So it's important to underscore the fact that, again, we have very few non-starters. What I would suggest to the person who posed that one is to talk about the specifics with the mortgage loan consultant. Medical leave in general, depending on how long it was, how well it's documented, if you have a letter from the employer documenting it, or some other form of documentation, in a lot of cases we can end up using the full income, because again, it's more about what you're going to get in the future, that continuance and stability of your income, but we do want to have an explanation that makes sense going back. So as long as we can document that story and our underwriters are kind of satisfied with the story and it all ties together, in many cases we can offer something that meets your needs. I'm always hesitant to provide a yes or no, because the reality is it depends, but that's why I can't encourage everyone enough to just have that free consultation, because one of our mortgage loan consultants will go right over to our senior underwriter's office and explain the story and lobby on your behalf to make sure it makes sense, and we will lend wherever it makes sense. That's the bottom line.
it looks like one more question came in, and we'll be able to ask that. So if a name is on a home and I want to buy my siblings out, do I agree? Do I get straight to the mortgage?
I think this one's similar to the inheritance question, and this is something that we see an awful lot. The inheritances, inherited properties are rarely, I shouldn't say rarely, but in many cases are not bequeathed to a single person. It's oftentimes siblings, multiple family members. They each have a share, and obviously that doesn't necessarily make sense. You know, you're not all, in many cases, going to live together in the same house. So yeah, I mean, we can absolutely do that. You buy out the other co-owners. As far as how it's actually treated, that's more along the lines of how the sausage is made, which I won't bore everybody, but it's definitely a valuable conversation to have with your mortgage loan consultant. But suffice it to say that we can do it, we do it all the time, and you should definitely give us a ring, and we'll talk about it.
So what now?
Yeah, so what now? I mean, if I haven't beaten the dead horse enough, I mean, contact a mortgage loan consultant. Get that free consultation regardless of whether you think if you just signed a new lease, you think you're another year away, that's fine. We want to talk to you. You're not wasting anyone's time. And on the contrary, you're probably saving everyone time because we want to stay in touch with you. We want to follow up, and we want to make sure that we're doing all the right things on the path to get you on the path to home ownership. Go to our Homebuyer Education Center on our website, check out our online calculators, read some of the articles that we have there. There's a blog post that I just wrote a few weeks back about ARMs, and it kind of expands on what I talked about between ARMs and fixed. Just educate yourself. Register for CFCU's Home Advantage program. It's right there on our website. It doesn't cost anything. We'll get you access to the site so that you can be the empowered shopper. You can learn more about how much you can save by using one of our realtors. We can put you in contact with one of our agents if you're at that stage, but if you're not, that's okay too. Again, doesn't cost anything. And just let us know where you are in the process. Make the connection early. We'll introduce ourselves, and we'll let you know, what we think you should be doing or not doing to help you achieve the dream of home ownership, maybe a lot sooner than you thought.
Wow, thank you, Kristen and Jeff. That wraps up our webinar, 10 Things You Need to Know When Buying Your Next Home. An archival link of this presentation will be sent to you in the next couple of days. In the meantime, if you have any questions, please do not hesitate to contact us. Thank you for your time and attention.
You all.
Thank you.